Hi, I'm Sayal Kharbanda from L&T Mutual Fund, and today we are going to talk about bonds. What are bonds? What are bond yields? What is their relationship with stock markets? And what should investors do in the current environment? To begin with, bonds are fixed income instruments which are used or issued to borrow or raise money. These could be issued by a corporate, a bank, government, or any financial institution. The borrower of the bond pays a fixed interest rate to the investor or the bearer of the bond. Hence, it makes these securities relatively less riskier than stocks. Now, let's try and understand what's the relationship between bond and stock market. If you take textbook example, there's an inverse relationship between the two markets simply because these are two different investment avenues. And if an investor has to invest in one, then he would have to withdraw from the other asset class. However, in real life, this changes. There is no standard relationship really between the two. This would vary. It will depend situation to situation. At times, there could be a positive relationship. There could be an inverse relationship or sometimes a moderate relationship between the two markets. It depends on several factors. However, the two key factors which impact are first, interest rates. If the interest rates are rising, it's obvious that investors tend to choose bonds as an asset class. Hence, they prefer bonds, and there is a flight to safety from a riskier assets like equities, and vice versa. The other factor that has an impact here is which part of the business cycle the economy is currently in. Stocks are typically anticipated, and hence they tend to react much faster than interest rates when the cycle in the economy changes. So, right from the bottom of the recession, picking up to peaking at the expansion stage, there is a difference in how these two markets behave. So there are several stages in between. Like in stage 1 and 2, there is an inverse relationship between the markets. So different stages, there is a different relationship between the two markets. Now, we've seen that the yields have inched up quite a bit in the last, especially 2 months. Again, there are multiple factors impacting this. However, there are three key factors which have had a massive impact on this run up. Two are domestic factors: one, inflation; second is fiscal deficit; and third is US yields, which is an international factor. Inflation, we'll touch upon first. Inflation, though, has moderated in the last 2 months, mostly on account of food prices having fallen. However, your commodity prices continue to rise and your core inflation still remains sticky. Hence, this has fanned inflation risks, leading to the inch up in the yields. Second is fiscal deficit. Fiscal deficit was announced in the budget in February. Fiscal deficit for the current financial year as well as for the next financial year has been pegged at higher levels, which means nothing but that government is going to borrow more, hence more demand for money, leading to higher cost of money, which is nothing but increased interest rate. The third factor, like I said, is an international factors, is US 10-year Fed yields. In United States, the 10-year Fed has rallied quite a bit in the last several months, especially from the levels of 0.60% in the month of August 2020 to currently around 1.5 to 1.60% kind of levels. What this implies is that we may see inflation recovering faster in US and also tapering happening earlier than expected, which in turn means that RBI may be forced to inch up or hike rates, say by 25 basis points in our country as well, in order to match the differential between the two nations. So all these factors have had a massive impact on the yields, and that's how they have reacted. Now, very important and the last thing to know is what should investors do in the current situation? As we know, interest rates are rising. So it won't be incorrect to say that, we've entered into a new cycle where the rates have started going up. Hence, it's important for investors to take a very, very cautious approach. And our recommendation to the investor would be to pick up those schemes where the duration of the fund is lesser than their investment horizon. Now, how this will help them is that it will help them minimize the capital loss that may occur when the yields rise. Another recommendation that we would like to give to our investors is that there are certain funds in the industry which are trying to play on the steepness of the curve, which is the difference between the shorter end of the curve and the longer end of the curve. To our mind, those funds are better equipped to take on the adverse impact when the interest rates move in an upwards direction going forward. I hope the video is useful. Happy investing and thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.